hope to present to our listeners the opportunities and challenges in these new landscapes.
Okay.
Yes.
Interesting. I think, did Lemuel tell you about me or anything?
No, he just sent me a contact and he told me to sort myself out from there.
Nice. I am Joseph Maina.
Okay.
I am the founder. I'm the founder and CEO of Collectr.
Okay.
But prior to that formation, I have been in the banking industry for more than 10 years.
Okay.
Started off from the lowest point, which was data entry, grew in ranks and moved on to consulting. And basically, after making too much noise about what happens in credit and collections, na mambo kama hiyo, I decided that you don't just talk, you have to do and show people. Because at the end of the day, you can't be telling people that credit is supposed to be done this way and you're not doing it.
Yes.
So I stopped hiding behind people.
Okay.
And that is how I got myself doing incorporation of Collectr Consulting. Collectr basically is risk solutions. We are focused on everything credit risk, so that you don't wake up every morning and start doing banking, doing any other thing. Credit is a lot of work, and we have decided to specialize on it, become the best, because we have very many people doing collections, we have very many people doing trainings and all that, but still non-performing loans are going up. So that is where now Collectr comes in. Collectr, as you have seen, the name is a tweak or twerk of a collector. I've been doing collections for the longest time, and I would say God has graced me or favored me in the sense that I talk to people and they pay. So I needed also to look at it differently. The first time I got into collections, I was thrown in while working at Faulu Microfinance Bank.
Okay.
And coming from a customer-facing role, you expect that people will listen to you when you're asking for money, but that did not happen. I was beat up by a 70-year-old Muze, and I couldn't return fire with fire. So I had to learn different ways of now handling people. And that is how I have gone as far as looking for certification, learning from global experts, and here we are with you, Wandiri. So
Yes.
I'm glad to be here.
Yes.
Eager to hear from you. Eager to share wisdom. I know there is a lot we can do together.
Yes.
And basically that. Lemuel is a good friend of mine.
Yes.
I just did a training for them with CIS Kenya in Mombasa during this COVID. It was one of the first during COVID where we did it physically at the White Sand Sarova. We had a blended training session, which was both physical and online. So it was an amazing time. We tried something and it worked. And I think this is a beginning of many others. And I love what I do. So asante sana.
Yes, Mr. Maina, it's indeed a pleasure hosting you. And we hope our listeners will get nuggets of wisdom from this podcast.
Good.
Yes, I begin.
Mm-hmm.
Briefly tell us about Collectr and your role at the firm.
Okay. As I said earlier, I am after making a lot of noise about what financial institutions, collectors, and other stakeholders should do and what they should not when it comes to credit risk management. Collectr was born. Collectr was born late last year. That is on 31st December 2020. Our job is consulting services that deliver maximum value to customer bottom lines through innovative and market-driven solutions. So the only language we speak as Collectr is bespoke solutions for clients. Our solutions include, but are not limited to, credit repair, where we are saying that somebody is already in debt and we are helping them come out of it. It might look like personal finance management, but it is not. We are purely dealing with people who have become lonely because they are indebted, and some are in bankruptcy. Then we have data rehabilitation, where we are saying somebody is bankrupt. We want to take him out of this position, so we rehabilitate them like would somebody who is addicted to drugs. Then, of course, we have credit counseling, where people will come in and they meet our head of alternative credit services, who will be talking to them, listening to them, and being able to advise on the various ways they can move ahead. Then we have creditor negotiation, where we are saying that if somebody owes Wanderi some money and they are not able to talk to you directly, Collectr comes in and becomes an agent for you, where we will go speak on your behalf. And this is something that is not in the market currently. So lawyers are the people who usually do this, but we are saying that you need somebody who has been able to negotiate, so he can get you better terms so that you move out from the position you are in. Then we are also doing actual debt collection. And the other thing we are doing is credit scoring model creation. We have seen this in the market, but we also do this for the smallest of SMEs. Then our competitive advantage is that once we come in and start working with you, we do loan portfolio audits and advice. Are these guys going to go into collections, or are these guys going to be followed by your customer service representatives? Then, of course, there is Collectr training. We have a joint venture with the International Center for Professional Collections, where we are doing certifications for collectors. We are training them on new methods of collection, and from that, we expect that the results will go into excesses, because we are saying at the end of the day we need the NPLs going down. So that is where we are coming in with Collectr and the International Center for Professional Collections. I think back to you, Wanderi.
Interesting. There was growth in NPLs and debt distress for the better part of 2020 owing to the pandemic. What are some of the lessons collectors have learned from the pandemic?
Good question, that one. I would first refer to what is happening in our local market. The Business Daily Africa talks about NPLs have risen to 403.9 B in October, from around 350 million at the end of February. I think that is the sharpest 8-month increase in recent history. For us as collectors, this was not something that we had prepared for, but we have learned a few lessons. One is that we need to segment our clients, because clients do default, but that does not mean they are cut from the same cloth. Then our strategies also need to change. If we are going to survive as collectors, as service providers, we must be dynamic in our solutions. We hadn't prepared in advance for COVID. Nobody was. So when this has happened, we need to re-strategize, rethink how we do things. I always say that the call center type of collection might work or might not, but you need to have a solution for every client that comes your way. Then, of course, our policies. As financial institutions, banks, SACCOs, microfinance, and fintechs, we have seen that things are not moving the way they're supposed to be. And I would say, and I always say, insanity is doing something over and over again and expecting different results. So what we have learned also is that we must redo our policy in light of the matters arising. Then the fourth thing is our solution range. Our size solution does not fit all. Our call center mentality in collections will again work or not work. So if it's a client, we are dealing with millennials. In Kenya, we are saying that over 70% are below 35 years. So meaning these are millennials. These are guys who would not want to to keep receiving phone calls. So you need to change tact and see how best to move ahead. So I think that covers basically what some of the lessons that we have learned. And it is national. It is. I would end this by saying that it is natural when facing a large wave like COVID to start swimming fast, but sometimes it is best just to slow a little and ride with it. Customers will be expecting tolerance from the lenders, and the lenders should ask for the same in return. It is better to take a bit of time and ensure that there is the right outcome for both parties. Herein, we call it collection, and on the other side, we are saying the lenders get their money back. Over to you.
Interesting. I like that you gave the lesson about client segmentation, which is a very good thing to classify clients according to their different ability to repay their loans. And also, I also think it's time the microfinance and banks they change tax. The call center collection, in my view, is not working as it should. On to the next one. The growth in digital credit poses the threat of default. What are some of the risk mitigation measures lenders can take to minimize this?
I think I would be of a contrary opinion when we say that digital credit poses the threat of default. Digital lending, or what I call the alternative circle, does not pose a threat to default, but rather offers a medium for financial inclusion for all. Digital lenders have in fact made most of our lives easier, as access to finance is at the touch of the button and onto M-Pesa. I chose M-Pesa because it's easier to relate to. It is imperative to note, however, that improper credit appraisal techniques will eventually lead to default for any financial institution, be it a bank, microfinance, SACCO, or digital lender, notwithstanding. The question would beg is that does the ease of access through these digital lenders increase default? I would say no. So some of the risk mitigation lenders can make to minimize this is number one is train their staff. You have to train your staff on credit. We have a Kenya School of Credit Management, and I think there is a course on for credit professionals in Kenya. But now the other question begs: do the things that we teach people apply to modern day lending? So that is for the listener to think about. But the other thing is, once you train staff and they understand what credit is about, you are able to look at the processes. Are the processes working? If they are not working, can we do a loan portfolio audit and see is it the policy that has a problem, or is it our people? So you can't have a customer service guy and you're telling them to go collect. So you have to look at it in a deeper way. Then the other thing is that there is so much that is happening in the industry. You have to be dynamic. I would say one size again does not fit all for lenders. So once you train your staff on credit, you update your skills, the policies are in place, then you will now again require to look at performance management. You would want your staff also as they lend out money, they are getting it back. So there is also the matter of performance management. You don't want to do predatory lending and such like things. Over to you.
Interesting. I think it's the on matters credit training. It should be a requirement for any financial institution, and also the policies need to change. On there's a point you mentioned about digital credit. What role do you see machine learning algorithms playing in the digital credit sector? Seeing that alternative credit scores have based on behavioral patterns are on the rise, and approving a better means of assessing clients.
Okay, great question, that one, Wandiri. I think machine learning has flipped the script on traditional lending. You can't run away from machine learning, that is one. And when you see financial institutions still doing the same things the same old way, it is painful. So we are saying machine learning is allowing for more accurate and faster decisions by shifting traditional decision making from analysis of individuals to analysis of trends and patterns. The results for lenders is more repeat business and lower operational cost. I would echo what Mark Andresen says, an internet pioneer and fintech investor, that software is eating the world. According to Turnkey Lender in reflection of the transformation, the global digital lending platform market is expected to approach $20 billion by 2026. And we can say that we can never run away from this. We are digital, and this means that we cannot move away from the reality. So we have to be dynamic as individuals, as digital lenders, as collectors, that we can't run away from machine learning, AI, and the matters that go with IoT and such things. Over to you, Wandiri.
What do you think about alternative credit scoring, which are based on behavioral patterns?
I think that is the best thing that will ever happen to us, that we can be more objective, that when I'm judging Wandiri from the back end, I'm able to know that that his character through the scoring and all this, I'm able to be more objective rather than subjective. I remember when I was doing credit analysis in a bank back some few years ago, that you would once you see a client, you would make haste in the decision that you don't like them, so they will default. But when it comes to these algorithms, the scoring and all this, we are going to improve this. We will make better decisions, and these better decisions means that even for staffing, if wherever I am currently, I'm in Laikipia, that from the back of a machine or from the mobile phone, I can lend to a customer who is doing very well in an SME in down at on Kimathi Street. So I think this is something that we cannot run away from.
Thank you for that. Into my last question. What are some of the areas you are seeing growth going forward into 2021 in the credit and collections sector?
Okay. I think allow me to speak more on debt collection. In many cases, previously our strategies have remained complex, inefficient, and outdated. In today's fast-paced digital world, customers want flexibility, accessibility, and choice. So whenever you have paid your loan, you feel more comfortable and secure. So where we are looking at artificial intelligence, this will really come into play. That a few years ago, debt collection was basically disrupted by AI. The same to everything about credit risk. Artificial intelligence empowers companies to use advanced analytics and machine learning for their own benefit. So we expect with AI coming into credit and collection, number one is improvement of collection rates. That once we understand data, we're able to identify trends and familiarity and market opportunities. Our outdated debt collection strategies relied more on personal emotion, how physically likable you are, and that knowledge alone. Rather, using the concept of numbers and data, you now create an impartial solutions. And number two is that AI will bring customization and bespoke, what Collectr is also about. Customization of the customer experience using this science. Millennials and Generation Z, these guys from 1996 to 2010, these are guys who are looking for new desirable solutions when it comes to lending or making payments. They do not want to receive calls during office hours or hear their phones buzzing with time-consuming calls when they are on their WhatsApp or their TikTok doing videos and all that. So based on the findings of this human, social, and economic data, credit and collection strategies can be prioritized and applied based on the information associated with each individual. AI will give you the knowledge to tweak your approach to ensure you only use the best channel, and where likely you will get a very positive response. So what I'm saying is that we shall be able to streamline our operation if we agree to be dynamic and flexible in coming days. We cannot run away from what is happening in the market, in the world. Yesterday, Elon Musk, born in Africa, is now the world's richest man. what I've carried away from that development is that you have to be dynamic, see the trends, run with them, so that you are able to get to the position you want to be in. Asante.
Yes, I think that is all we had for today.